We are back in the New York groove. Thank you guys for joining the 980s podcast hosted by yours truly, Kevin Thompson, founder and CEO of 980 Capital Group. Thank you guys for joining us. As I always say, subscribe to the channel. As I always say, go and get my book, Get My Beat CFP live on Apple and Amazon. If you have any questions, comments, or concerns, you can email us at info@9icapitalgroup.com. Send us your questions. Go to the website at www.9icapitalgroup.com. Schedule an appointment. As you know, we're here to do what? Educate, empower, and engage. And today, we're here to talk about what a 50 basis point cut means to your portfolio, what it means to your borrowing costs, and what it means for the overall market. You know what? Let's break it down. Let's get it. So the Federal Reserve just came out and cut rates by 50 basis points, but that's not the reason you should be concerned. That's not the reason you should be all, well, what's going on? The reason why there should be some semblance of like, aha, really, what's the real reason behind this is because, well, they think the economy is slowing. But in what regard is it slowing? And right now, it's strictly in two phases. One, it's slowing in the employment sector. Now, Fed President Jerome Powell came out and said, you know what? Unemployment is slowing a bit, and it's not a big concern because we have a lot of people employed. He also said that number is being pushed up because of migration or immigration, and now you have more people in the job force, and that's why you went from 4.2 to 4.5 or what have you. And the more people in the force, of course, the lower denominator, the number should get a little bit larger, et cetera, et cetera, et cetera. So, or the higher numerator. My math skills aren't very good, but be that as it may, it's important to understand that they're concerned about the labor market because you know what? The Fed has what? A dual mandate, price stability and full employment. So let's look at what does this mean for your portfolio? How is this going to impact borrowing costs? And you can already see how it's impacted the markets. The very first day, the Fed came out and said 50 basis points, which I'm going to tell you this. I'm going to say this. It shocked me. I thought they would be more conservative, but it shocked me. I thought, oh, it's going to be 25 basis points. Very easy. They don't have to peel that back. But it was 50. And the reason why it may have been 50 was because Jerome Powell wanted to do a cut back in July, and they just didn't get it done. So this is just basically two 25 basis point cuts that he wanted to take care of back a while ago. So what exactly is a 50 basis point cut? Let's just start there. Essentially, it's a 50 or 0.5% reduction in the Fed funds rate. And the Fed funds rate is what banks borrow from each other. It's what they charge each other to lend money. So it's one of the way the Feds control the economy. The question is, like I mentioned before, why now? They're trying to not choke off the economy too much and not be late to the party because other countries around the globe have already started cutting rates, and they don't want to wait too long, but they also don't want to be too early because they've known Fed policy in the past had this yo-yo approach where, oh, inflation, oh, here inflation's not there. Oh, we got to raise rates, we got to lower rates. Nobody wants the yo-yo effect on interest rates. So it's very important that they do this so they can do what? Land the plane successfully. So we call it the soft landing. So that's what they're headed for. And that's what the markets, as you can see, right after the Fed announcement, they weren't taking that too calmly. Markets got a little bit volatile. Markets went up a little bit, then they went down a little bit. They ended kind of down on the day. But at the end of the day, the markets started to rally the following day because they took some time, they digested it, and they said, oh, okay, 50 basis points. What is that good for? It's good for small caps. It's good for banks. It's good for a lot of companies because a lot of lending. It basically opens up lending. It opens up the housing market. We're going to get to that here in a second. But it opens up a lot of money in the economy so the economy can start rolling again. The main point of this is that they're trying to juice growth, because if you can lower interest rates, which again, the interest rates, that's what they're actually paying on their debts as well. They have to control the interest rates of what they borrow from other countries as well. They're tired of paying these trillions of dollars a year in these interest rate payments. If they can lower that as well, that is a good thing. And if they can open up the growth, that offsets some of the cost as well. So this is almost like a win-win for them. But again, that dirty word I'm about to talk about. Let's go into the second part, inflation. I don't know what I don't know. I'm not an economist. I just play one on TV, right? But here's the deal. I'm going to show you this. Let me pull this chart up. Because in 2022, food at home went up 11.8% unadjusted over 12 months. But if I look at 2023, food at home, 1.3%. Food away from home in 2023, 5.2%. Food away from home in 2022 was 8.3%. The reason why I'm showing you that is because, well, that's all fine and dandy. Inflation's coming down. Inflation is slowing down. It doesn't mean prices are coming down. It just means inflation is slowing down. So that damn Chick-fil-A sandwich that I was buying for $5 and some change back before 2019, which is now $9 and some change, it's very hard to justify me paying $10 for a sandwich, a drink, and some waffle fries. I'm sorry to say that. It's a good sandwich, I guess, but at the end of the day, it's becoming far too expensive because you know why? The prices are not likely to come down. They're just not likely to rise as quickly as they were, which again goes back to what? If my grocery cart is getting more and more and more expensive, that's less I take home. If everything around me is getting more and more and more expensive outside of food and outside of energy, of course, I mean food, but outside of energy, then where am I making money? Where am I breaking even? Childcare costs, home, insurance, all of it's continuing to rise. It's not coming down. It's not being in a deflationary environment. So that is a main sticking point for a lot of people. And it's going to be a main sticking point as we get closer to the election as well. So we talked about Fed funds. We just talked about inflation. Now let's talk about how will this impact your portfolios moving forward. I'm a big fixed income guy. I think fixed income is going to be great. So let's talk about fixed income. For bond heavy portfolios, a rate cut is a double-edged sword. While the value of the existing bonds might rise because, of course, lower yields, lower rates, higher bond prices, higher bond values, yields on future income investments will be lower. So it's important that we may need to lock in some higher yields at these times because now we're getting the higher yield and the price appreciation on people buying our bonds at ever higher prices. But when price goes up, yields go down. So locking in yields today may be an opportunity there. Again, this is not a recommendation. So this is especially important for those approaching retirement and relying on income from bonds. We're doing a pretty good job at that, I believe. The allocations there, we have some actively managed bond funds, so this is good. From the equity component, equities often respond to rate cuts as borrowing costs from a lot of these companies, especially smaller cap companies, go down. Not all sectors will react equally. Tech, for example, often thrives in a lower rate environment. You're going to see tech possibly do very, very well. Financials might see some profits, but their margins may be squeezed. So you may need the the smaller banks, the regional banks, and things like that may see some squeezed margins because of lower interest rates, because they like the higher interest rates environments because they can charge more on the money being borrowed. Now, real estate investors, the rate cut is generally good news. Cheaper borrowing costs can spur housing demand, commercial investments, potentially driving up property values. One thing's important to understand: when we go back to inflation and CPI, we're talking about what? Owner's equivalent, which makes up over what, 30 something percent or something like that. So it makes up a large component of the CPI. That has been very, very tricky in this current environment. And Fed Jerome Powell mentioned that, because there's people are sitting on these mortgages. People are sitting on great rates at this current time. Three and a quarter interest rates on their homes. So what Fed Jerome Powell said yesterday was that, hey, you know what? We need to bring down interest rates to unlock some of those trapped borrowers, so they can get out of those mortgages and do other things to free up capital. That's another reason why the rates came down yesterday. So let's talk about part 3, borrowing costs, how it impacts borrowing costs. On a personal level, if you got loans, especially variable rate ones like credit cards or certain mortgages, a rate cut could lower your payment. This also applies to home equity lines of credit and auto loans. So if you're thinking about taking out new debt, lower rates make a more attractive option. For businesses, it becomes cheaper to finance new projects or expansion. This can drive growth, especially for companies' large capital expenditures. However, with low rates, you want to avoid being overly reliant on cheap credit. It won't last forever. So I want to kind of switch to market impact. We talked about that a little, but I also want to talk about how it's going to impact the dollar. The stock market reaction in itself has been positive, as we know. Rate cuts tend to buoy the stock market. Investors are looking for higher returns, and bond yields are lower. Equities can become more attractive. Yeah, the party's back on. The Fed's putting more alcohol in the mix. But let's talk about the dollar index. Lower interest rates often weakens the dollar against international rivals. So you may see a weaker dollar, even though off the back of the interest rate cut, the dollar actually rallied, which is kind of interesting. So when the dollar drops, it makes U.S. exports cheaper, which could often benefit manufacturers and our tech industry. However, there's a caveat: a weaker dollar can increase the cost of imports. That's just Econ 101. So against the large currency basket, the dollar's position against currencies is essential, because it's the reserve currency. So a weaker dollar might boost returns for U.S. investors holding foreign assets, but it can also make imported goods more expensive. So let's wrap this up and say why it matters. So with portfolio positioning, lower rates, you want to revisit your asset allocation. Are you too bond heavy? Do you have exposure to sectors that might benefit from cheap borrowing, like tech or real estate? What does your international exposure look like? If the dollar is weaker, it could be a good time to review your international investments or even consider new ones. And of course, borrowing strategy. Now may be a good time to refinance existing loans or lock in lower rates for longer term debts. So I hope this has been a valuable use of your time. I know it was really econ heavy, because what does a Fed 50 basis point cut look like for your portfolio? We talked about how it's going to impact equities, how it's going to impact real estate, how inflation plays a big component of this call. We also talked about how borrowing costs will change. And we also talked about how the Fed is really tied to their dual mandate: price stability, which is inflation, but full employment, which again, they see a tad bit weaker than expected. So as always, if you're unsure about these things and these shifts in your financial strategy, feel free to reach out to us. Let's make sure your portfolio is positioned to success. Thank you guys for listening to the 9 Innings Podcast. Subscribe to the channel. Go and get my book, MLB to CFP, live on Apple and Amazon. You have any questions, comments, or concerns, you can email us at info@ninecapitalgroup.com. Send us your question. Go to the website at www.ninecapitalgroup.com. Schedule your appointment. As you know, we're here to do what? Educate, empower, and engage. And we talked about the Fed 50 basis point rate cut, what it means for you, what it means for your portfolio, how it's going to impact the economy. Heavy Econ 101. Stay humble, stay safe, my friends. I'll see you again soon.